Now's the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions. And as always, we have our three topics to consider. First one, third quarter earnings. We are pretty much just past what I believe is the busiest part of earnings season the last couple of weeks, or I guess by the end of this week, I think more than half of the companies on the S&P 500 would have reported earnings in the United States. So third quarter earnings, Fed rate decision, as I mentioned off the top of the show, Federal Reserve head Jerome Powell will be speaking to all of us at 2 p.m. this afternoon, and he'll talk to us about their rate decision. Right now, it looks like they will not raise rates. That is the expectation. But what will he say? Are they going to say that there's still a possibility for more rate hikes this year, maybe next year? Or will they give an indication that they think the rates where they are today are high enough to restrict the growth that they want to restrict? They still want the country, the United States, to grow. They don't want to see a recession, but they want to limit that growth. And lastly, patience in these markets. I've been getting a lot of questions recently from investors asking, can we still buy these investment ideas? And the answer is yes, but I think you got to be a little bit of show a little patience, or be patient to see these investment ideas grow for you. So let's talk a bit about the first one, third quarter earnings. And as I said, we've been getting a lot of third quarter earnings. A lot of companies that have been reporting, been reporting really good numbers. Yet many of these companies have been punished by the market. We've seen a sell-off either that afternoon after the market closes and after hours trading, or the next morning, or even for the next day or two. We've been seeing a lot of these companies sell off. And I think one of the reasons for that is that a lot of these companies are saying they are seeing a slowdown going forward, that the earnings expectations for the next quarter or two are perhaps a little lower than what analysts and, as we call it, the street was expecting. So the companies coming in reporting really good earnings, beating on the top and bottom line, earnings per share growth, revenue growth, but yet guide lower going forward. That's just not good enough, it seems like, for the stock market. And the market is selling off some of these names, and of course, giving us some good buying opportunities. One of the names, one of the charts I have here, we have a bunch of charts to get through. First one here is Citigroup. We talk about Citigroup all the time. Now, Citigroup, interesting enough, is one of those names that reported fantastic results. When they reported earnings, the stock ran higher, a couple of percent higher that day. But here we are, Citigroup back at 52-week lows. Citigroup pays about a 5.5% dividend right now, which is high for a name like Citibank. You're noticing, if you look at the far right, you've seen the stock fall off. Trades at a multiple of like 6 times earnings. A lot of the U.S. bank stocks, and I'm going to show you another one in a second, are trading at 6, 7, 9 times earnings. Again, very low for such a large bank, and a name that has grown and has done as well as it has over the last little while and over the long term. And here's another one, Bank of America. Bank of America I've had on this show many times, and once again, looking at a high back not too long ago in the low 40s, trading at around $26, $27 today. Bank of America doesn't pay as high a dividend as Citi, in and around just under 4%. But once again, really good earnings, but being punished, being punished for what the stock market believes as slower growth to come. And that's why you're seeing a name like Bank of America trading at around 7 times earnings be, punished by investors and sold off. A name we talk about all the time, Meta, or formerly Facebook. Fantastic chart, one of the best performing stocks on the S&P 500 over the past year, but yet still a lot more room to run. And it was interesting how the market perceived Meta earnings. Meta earnings, in my opinion, were one of the best earnings reports I've seen from Meta going back a long, long time. But what the market focused on was, again, what they're predicting for the next quarter. And it was something like they were predicting between 36 cents and 40 cents per share. And the market was anticipating 38. And so maybe it being in the middle of the range wasn't good enough for investors, and they were looking more at maybe it should have been higher. I'm not sure. The stock was punished in after-hours trading. Obviously, a mistake. Stock actually dipped down into the low 290s, and now we're seeing it back about 300. And I believe today actually is above 300. So a quick bounce back after a sell-off when the earnings came out. We have another chart on Alphabet, or formerly Google. Again, this name was punished because even though they get most of their revenue from YouTube and search, as we all know, their cloud business went from 28% growth to 22% growth. Still pretty good, but below what it reported the quarter before. You couple that with Microsoft saying they actually increased growth with their cloud business, and we heard from Amazon, their AWS, and their cloud business was okay. It made Alphabet's cloud business look weaker, and the stock sold off. This stock was in the around 130, 132, sold all the way down into the low 120s, as you're seeing here. So my opinion is, the reasons for these sell-offs, I just think were overdone and not valid. I think the market took these companies, sold them off for reasons, in my opinion, that I just think were overblown. These stocks are still doing well. I should say the companies are still doing well. Their share prices or stocks are not reflecting how good these companies are doing, like Meta, like Alphabet, like Citigroup. And I just think that represents some good buying opportunities for investors. Second point I wanted to discuss that individual investors should focus on, as I mentioned, is the Federal Reserve and the rate announcement and commentary that we're going to hear this afternoon. And as I said, we're not expecting the Fed to raise rates. And the hope is that really the Fed probably is done when it comes to raising rates. Some may say, well, there's a small chance they may raise in December, and then there's a small chance that they may raise early next year. I think they're done. I think the market, with the yields on government bonds being as high as they are, I think the yields are doing the work for the Fed themselves. And so they don't have to raise interest rates, which actually take short-term rates higher any longer. Again, my opinion. So we have a chart here about Fed funds rate increases since 2022. Now, we've seen this chart before. Most interesting thing about this chart to focus on is June and September, two meetings that rates were not raised at. And if they don't raise rates today, it will be the first time that the Federal Reserve goes two meetings back to back without raising rates in something like almost 2 years. That goes to show you how of an aggressive rate hiking cycle or rate hiking program that the Fed has been in for the last 2 years, that this will be the first time in a couple of years that the Fed back to back does not raise rates. Unbelievable. And that's why we're seeing a lot of pressure on the economy, seeing a lot of pressure on the economy here in Canada as well, because central banks, Bank of Canada and the Federal Reserve, have been in such an aggressive rate hiking mode. And we'll see what they say. I still believe they're going to speak hawkishly or aggressively in terms of saying, we could always raise rates if the data points to raising rates further. But I think they're on hold for the foreseeable future, and possibly we've seen the peak in rates. The third topic I wanted to touch on is this idea of patience in the markets. And I bring this up because investors are asking me the question, Alan, can we invest in the stock market today? With interest rates higher, rates on GICs, rates on high interest savings accounts, money market funds, etc., bonds in general, government bonds, corporate bonds, rates are much higher. And so once upon a time, when we thought that you needed to be in the stock market to make a little bit of money, now with interest rates a little bit higher, you can actually think about buying some of these higher rates or investment vehicles that have or are paying those rates, such as 5%, 5.5%. But I believe, in my opinion, you can continue to invest in the stock market, especially if you're looking for growth. And, when you factor in inflation and taxation, a lot of what you're making on a 5 or 6% GIC disappears, right? It's disappearing to taxes or it gets eaten up by inflation. But there are a number of good quality investments that if you buy them today, I'm going to show you in a minute or in the next few seconds, that over the long term will be fantastic investments. And how do we know this? Because in the past, they've been fantastic investments. And many of these investment ideas, or at least a few of them I'm going to show you today, pay great dividends and have only ever increased their dividends over time. So the first one I wanted to get to, TD Bank stock. Now, TD Bank is a name, and here's a long-term chart. And you can see it's had its ups and downs. But over the long term, you go from the bottom left to the top right. And yes, all the way to the right, we've seen a peak back in, I guess, 2021, and it's sold off a little bit since then. But this is a name I think you can get into today at a significant discount with a great dividend of about 5%. And it's a name you can hold for the long term. And it's also a name I believe over the next 12, 24 months will bring investors good returns in general. Another name that I wanted to outline or to show you, again, stock we've had on the show many times, is Bank of Nova Scotia. And once again, taking a look at it from the long term, chart's not as nice as the one from TD Bank, but once again, you go from the bottom left to the top right, and once again, a sell-off over the last couple of years. Scotiabank stock now pays in the vicinity of 7.5% dividends. So if you buy the stock and the stock goes absolutely nowhere, doesn't go down, doesn't go up, you're still going to make 7.5% rate of return just from the dividends alone. And another name that I think over the long term can produce some really good returns if you have patience to hold. Another name here outside of the banking industry that I wanted to show, Home Depot, a name we all have grown to love and to shop at many times, especially in the springtime when we all go to fix up our gardens for the spring and summer. Here's a long-term chart of Home Depot. Once again, bottom left, top right, in terms of how the chart looks. A huge spike over the last, let's call it 10 years or so, 20 years or so. And you can see recently, stock is sold off, got as high as about $440 a share. It's now pulled back into the high 200s. So once again, buying a good quality name that pays a decent dividend. You know, Home Depot will pay you in that 3% range. So not as high as the other stocks, but should give you more growth than TD and Scotia will bring. And it's a name you could hold for the long term, and a name that if you have the patience to own, will produce good returns for you over a period of years or over the next 12 to 24 months. Lastly, I have a name that I've had on the show, Amazon. You know, Amazon, we all love Amazon. I know in my house, we get Amazon packages almost on a daily basis. Still, to my house, we were getting them during COVID times, and now that, you know, we're past the pandemic, we're still getting packages in my house. So Amazon stock, I think we have a chart of Amazon here showing that, again, you look at the chart, bottom left to the top right, sell off a bit, now a bit of a rebound into the 130s again. But again, this is a stock that was as high as 180 after they split. For those of you that are saying, wasn't Amazon a lot higher? Yes, it was a lot higher, but underwent a stock split in the last few years, and that has brought down their share price to more affordable for the average investor. So these are some ideas that if you're patient, I think will work for an investment portfolio. And when you couple patience in the markets, keeping an eye on the Fed, and third quarter earnings, these are the ideas that I think individual investors should be focusing on before you make your investment decisions over the next couple of weeks.